This is Kat Lyons and Bailey McChesney with Churchill Downs, the business we decided to do our common analysis project on. Starting off, Churchill Downs owns several different segments within the gambling industry, such as casinos, horse racing, and several different softwares for mobile gaming apps. They own and lease properties from coast to coast in several different states. They lease more than they own. Moving on to liquidity ratios, their net working capital ratio for 2015 and 2016 were both negative, meaning their liabilities outweigh their assets in both years, more so in 2015 than 2016. The current ratio for 2015 and 2016 were at 0.34 for 2015 and 0.53 for 2016. So they were below the desired value for the current ratio. For the acid test, the ratios came up with 0.12 for 2015 and 0.1 for 2016. Moving on to solvency ratios, the debt-to-equity ratio was 2.7 for 2015 and 2.3 for 2016. On to debt and asset ratio. For 2015, it was 0.73 and 0.70 for 2016. So over half the dollar they were producing in those 2 consecutive years were owned by outside investors. Onto activity ratios. The asset turnover ratio was 0.53 in 2015 and 0.58 in 2016. Accounts receivable turnover ratio is not applicable to this business because we do not have credit sales. Everything is immediately purchased or taken by the consumer at the time. Moving on to profitability ratios. Earnings on sales in 2015, Churchill Downs had the ratio of 1.9 in 2015 and 1.8 in 2016. Return on assets ratio, it was 0.04 in 2015 and 0.07 in 2016. That was our analysis on Churchill Downs. Thank you.